When it comes to dividend investing, one of the most attractive parts of investing into dividend stocks and ETFs could be a very high yield. And I do have to admit, higher yielding ETFs and stocks can be very attractive for investors that are seeking income. But there are several downsides I want to go over and warn everyone to watch out for. Now, as always, take this with a grain of salt, but these are generally things to look out for, such as the higher risk associated with higher yielding ETFs and stocks. Sometimes these higher yielding assets invest in riskier assets, such as junk bonds or other investments that carry a higher risk of defaulting, and even certain stocks that are continuously taking out more and more debt in order to cover their dividend payouts. Also, concentration risk. Some high-yielding ETFs invest heavily in a specific sector or industry, which can leave investors vulnerable to lose if that sector or industry experiences a downturn. One of the most simple and most important things I've learned over my years of investing is that diversification definitely helps your portfolio and helps you as an investor sleep well at night. On top of those risks, some of these higher yielding ETFs, which we are going to go over in a second here, have higher expense ratios. Now, this might not seem to be that big of an issue, but it does add up overall, especially as you get more and more money invested into these funds. Higher yielding ETFs might have higher expense ratios than other types of funds, which can definitely eat into your returns over the long term. Now, right here are some of the highest yielding dividend ETFs right now within the market. And as you can see here, 26.11% dividend yield. I mean, these numbers, some of them are just absolutely insane. So first, a good rule of thumb, you should definitely understand why certain funds are yielding such high amounts and note if there's any red flags involved with it. For example, REITs definitely yield higher, but it's because they're set up to do so, versus maybe an individual stock that's yielding extremely high because the stock has been beat down because underlying risks might be involved. Now, me personally, I have nothing against higher yielding stocks and higher yielding ETFs. I personally invest in many of both. But a few things to keep in mind is to look at the total return that the ETF or stock has returned over the long term. Generally speaking, with higher yielding stocks and ETFs, you're not going to see as much price appreciation. For example, if you look at the 5-year time frame and you look at JEPI versus the S&P 500, you can see as far as price return goes, which is just the price of the ETF, S&P 500 over the last 5 years has returned 51%, while JEPI has only returned 9.94%. But what's interesting is if you change the metric to total return, you see that JEPI returned over the last 5 years 41.3%, versus the S&P 500 total return 64.92%, which is still higher but not nearly as far of a spread as if you just look at price return alone. Now, where things get really interesting is if you add something like Q-Yield into the mix. Q-Yield is a very, very popular income ETF that I bet a lot of you guys either hold in your portfolios or at one point have thought about buying. But if you look at the price return total over the last 5 years between JEPI, S&P 500, and Q-Yield, you see that Q-Yield is minus 32.8%, which means from the looks of it, this fund is starting to deteriorate pretty bad over the last 5-year time frame. Now you might be saying, well, let's look at total return with Q-Yield because it does offer a massive yield, somewhere of around 11 or 12%. Q-Yield with total return involved altogether over the last 5 years has returned 18.46%, which again is not horrible considering the price return is so horrible. But it just goes to show that if you look at something, for example, like JEPI versus the S&P 500 versus Q-Yield, there definitely seems to be a winner and a loser here. The biggest tips I can give you when trying to seek out different ideas to invest into when it comes to higher yielding ETFs or stocks is first of all understanding the company or understanding the ETF and how it works. For example, a lot of these higher yielding ETFs have different mechanisms. Some of them use options and cover call strategies in order to shorten and downside risk, but then also seek less upside potential. There's different ways that these funds work. And before blindly invest into any of these funds or stocks, it should go without saying, but definitely understand how they function and what sort of returns in theory should be seen from them. The other piece of advice I would give you, and I would not stress this enough, is look back in history. History can't tell you what's going to happen in the future, but it can give you an idea of how things performed in the past. Using a tool like this on seekingalpha.com, it's a free tool. You can go to charting and you can match up different names. Like right here, we have JEPI and S&P 500 next to each other, and you can mess around with them. Look at what they've returned over the last years. also look at the price return versus the total return. And again, the idea is to see how they did over the last 5, 10, 15, 20 years in order to have an idea of how they're going to perform in the future. It's really important to consider these different factors before you blindly invest in super high yielding ETFs and or stocks, of course. The good news is that there are some very high quality dividend stocks and dividend ETFs out there. But it's important to assess your own risk tolerance and really ask yourself, what am I trying to get out of this stock or ETF? If you guys enjoyed this video, make sure to please drop a like on the video and definitely subscribe for more videos like this in the future. I'll see you guys in the next one.